Lovely. So we have Robert Rooney, Global Head of Technology, Operations and Firm Resilience at Morgan Stanley. We have Melissa Stevens, Chief Digital Officer, Head of Digital and Marketing at Fifth Third Bank, and Stuart Sopp, Founder and CEO of Current. I love this. We're all in this world where we wave now on. We're all very, very used to
Right.
our Zoom etiquette. But thank you, panel. Thank you for joining us for this discussion. So I thank Jay for giving us a bit of an intro. So I'm going to start off with Rob to start off with the first question, and I'll get everyone to come in and give their thoughts as well. As you know, leveraging emerging technologies is critical to a lot of the future success in the banking world and the financial services world. So what emerging technologies are you focusing on right now? So Rob, I'm going to go to you first.
At the highest level, and Jay did mention that, Morgan Stanley is a GSIFI, a globally significant international financial institution, and the regulators are acutely focused on us kind of being up and running all day, every day. So, we have to start with stability and security as our priorities, and that is job number one. But really after that, for an organization like Morgan Stanley, a global place like ours, it is really, like, I think probably everybody on the panel, it's going to come down to data and the technologies around that. And for us on our modernization journey, that is significantly about cloud. That is, Morgan Stanley moving to the cloud is really utilizing a lot of modern technology to effectively modernize our legacy applications, which allows us really to partner with fintechs and tech companies who offer some of the best solutions out there in order to accelerate our pace here. We are looking at everything from process optimization, which is really what Jay was describing in the second half, like the next generation of robotic process automation. But clearly blockchain is a priority for us in specific use cases. Quantum's a little further down the road, and it's something we're looking at. We have a variety of businesses, some of which will not necessarily be cloud driven. Stuart was on our side of the business a while ago and remembers that low latency trading is a critical aspect of what we do. Getting that down to single microseconds in latency is a critical thing for us and maybe somewhat unique to certain aspects of our business. But these are a whole bunch of the things that we're working on.
Interesting. Yeah, no, it's been very interesting to watch the evolution of cloud in banking over the past decade. It's been interesting to watch. I mean, maybe moving away from incumbent banks to the fintech space. So, Stuart, what emerging technologies are you focusing on now?
Thanks for having me. It's very exciting to be here. So we're slightly different. Obviously, the job, like Rob just mentioned, the first jobs, security and stability I think is table stakes for everyone for obvious reasons, right? When people give you the trust of giving their money to you. We're privileged at Current because we started in the last 5 years. We're already cloud-based and microservice-based, and we built our own banking core, which we started in 2016, which was deeply unpopular direction for most fintechs and most investors of fintechs, but now is becoming somewhat of a superpower for us as we go forward. And so that enables us product development and things like this. And so we're at this stage now. We're pretty dialed in on existing, what I would call incumbent or expected table stakes banking infrastructure and products and feature sets from that. And so for 2022, we're really excited about the crypto side of things. So for us, onboarding people, on-ramping people into digital currencies. I was a currency trader for many years, but most recently at Morgan Stanley. It was some of the best years there. I learned a lot there in terms of infrastructure build. And so for us, DeFi, that's decentralized finance, is very interesting for us. And so we're exploring high interest rate products. That's basically SEC lending. And uninsured, but that'll be rolled out. It's in alpha right now and be rolled out in 2022 for us. And I think just broadly, the emergent technology that I think we all should be looking at, and I think we should embrace from both an incumbent and a fintech is digital dollars. We've had digital dollars since the 70s. Now we have programmable dollars, right? And that's really exciting. We can program and make them do things. And I think stable coins and the wallets associated with them unlock a whole load of things that can be done. And so instead of waiting for FedNow and real-time gross settlements and all this other stuff and waiting for your wire transfers, that technology would dovetail nicely with everyone, in my opinion. And I think that's where we should be focused. Stablecoin regulation, compliance, and development of that technology. That's really where I think like some of the big unlock for America will come.
Yeah, I think removing that friction from the process is something people have been working on for a while. I want to go to Melissa to get your thoughts on the emerging technologies you're looking at now.
Sure. First, as Stuart said, it's wonderful to be here. Thanks so much. I'd say very similarly to what was shared already by Jay and Robert and Stuart. I would add to it is as we look at it, and certainly with client-facing businesses, which all of us are in, it's really to us about how do you continue to enable the employees and how do you continue to enable the customers. And so for us, the automation, as was talked about, is critical. The data and the way the data is connecting, and then the places where you can automate for them with artificial intelligence become incredibly important. So we're all the things that Robert said about resiliency and stability and security and moving into the cloud. And as Jay pointed out very astutely, the moving away from the legacy core banking and enabling ourselves in a more nimble fashion and modernizing our tech stack, if you will, absolutely critical. But from an emerging tech standpoint, or from what we've all been moving toward in the legacy financial services areas, it's the data and unlocking the power of data, and it's unlocking the power of the artificial intelligence and machine learning that we're training. And then, as Stuart pointed out, it's really removing friction anywhere and ever we can, while continuing to provide a safe and secure and resilient environment for our clients to operate in.
Interesting. So Jay, I wanted to go to you. I know you talked a bit about the emerging technologies in our framework before the panel, but now that you've heard sort of Rob and Stuart and Melissa give their comments, I mean, is there anything that they've left out or that surprised you that their organizations are looking at? Do you want to give a further comment on emerging technologies?
I think, obviously, you've got an amazing panel, so you've got some thought leadership here. I think the additional pieces are really around moving from RPA to hyper automation. That's something we're particularly excited about as process experts, because hyper automation lets you be more creative with your automation and lets you do a lot more than RPA. RPA inherently has some constraints, which hyper automation kind of gets you out of those constraints in some ways. The other areas I'm excited about are some of the fintechs that are putting together cloud native platforms that can come in and help traditional banks get past the constraints of their core banking systems, right? So whether it's in payments, whether it's in in lending, whether it's in mortgages, etc. In all of these places, there's a lot of innovation going on, and there's fantastic tools and platforms that's coming out there, which can integrate into traditional banks, can integrate into fintechs. It can create partnerships. It's going to be a very exciting space to watch over the next couple of years.
Yeah, no, I agree with you. It is going to be really exciting. And I'm gonna move on, and we're gonna have a kind of a short open banking discussion with Stuart. And I think it's also a good to kind of maybe have a little break from the pandemic impact that is coming into all conversations. But Stuart, I wanted to go to you because one of the things that's been fueling digital transformation around the world is this march of open banking and open finance. In the UK and Europe, it's very mandate led, and in the United States, it's more market led. How is this influencing customer offerings globally?
Yeah, I think that's a good question and well structured. So obviously in Europe, a far simpler, more streamlined regulatory process, right? So they it's sort of top down. They used to, before Brexit, there was only one, and now there's a couple if you want to encompass Britain, my home country. And so, but just to be clear, that mandate was effectively breached. Hopefully, I'm not tripping any lines here, but almost no banks hit the deadline, and they were more than willing to accept the fines. And so that should be called out. It was mandated, but like sort of. Here in America, it's much harder. It's a feature, not a bug, that we have a federal system, and so it's much harder to organize and to orchestrate consistent policy amongst all those banks, state, local, and all the rest of it, federal. And so that gap has been filled by Plaid, obviously, and a very important one. And I think this exists because of customer demand, and so I think there's a fairly unique customer idea that they have around banks, which I think banks are going to struggle to get over in the short term, maybe not longer, is that most people see banks as safe, secure. They don't want them to change, if that makes sense. It's somewhere where I park my money. I don't want too many fees because I don't think it's providing all that much value. And then I want to take a bit of risk by connecting to some exciting fintech or whatever it is, whereby I'm like, okay, I don't want my nest egg or something that is uninsured or potentially uninsured or whatever it is at risk. And so there's this sort of convenient situation right now where customers are getting best of both worlds, right? But when it comes to the fintech or the bank, they're sort of getting half of a good world, right? And so from a fintech side, we would very much like and have the core banking and the primary financial relationship, as well as all the exciting stuff. And I'm sure from the incumbent banks, they would much rather have the higher margin, more exciting products that potentially the customers are trialing right now. And so open banking is customer driven. I think it's worked potentially better in America as a market led versus top down, and for all the reasons I've just mentioned.
But I mean, are you kind of saying that no matter what the environment, the banks are kind of struggling to see what value they can add to this environment? Do you think that's true?
I think it's tough for banks. They recognize that without giving up the ledger and access to that data, that it's fairly commoditized at a certain level, and that customers will then potentially move if they can connect to things of value, right? So basically, when you look at commoditized products, it's not just banking; it's sneakers or whatever you want to call it. Whenever you have a commoditized marketplace, brand matters a lot, and then connecting to things of value. That's the other thing. And so if you're not connecting to things of value, you can't sort of moat people in. You sort of hold people in by those value chains that you connect to. And so if you refuse to do it, or you don't have those things of value, you're going to lose that customer. And I'm sure that's what all 9,000 banks and 10,000 credit unions are trying to work out right now.
Interesting. So I wanted to move the discussion on to something that a number of you have brought up during our discussion, which is sort of working in partnership with new fintech entrants and engagement models. I mean, we've all seen that sort of evolution of the fintech era that we've been in over the past decade, where we moved from fintechs will destroy all banks to, well, they're going to work with banks, and many organizations have sort of engagement and partnership models. So Rob, I'm going to start off with you to get your thoughts. How can banks really create an engagement model to work with fintechs in the best possible way? What do you think?
I think it's really critical that we get this right, and I credit the fintechs, including Stuart and his organization, and the fintechs that Jay is talking about, with really pushing the incumbent financial institutions to become much more innovative. Now, on the one hand, we embrace that. On the other hand, it's not that easy. I mean, if I can only just speak for our own firm, we have 14 million clients. We have about 4.5 trillion of assets under management. We've taken in about 300 billion of AUM just this year in 3 quarters. And if you think about some of the fintechs we compete with, that's a big number. I think strip about 1.3 billion attachments a day and scan them for cyber. So a lot of the fintechs, and frankly, a lot of the small tech companies that we are very keen to partner with, are not at the scale that we need them to be to really engage significantly with us. So we have a partnership where we engage with them early, but we have to grow together, and we have to make sure that they understand what it means for us to actually bring them into a proper partnership with Morgan Stanley. But there's no question that there's a ton of innovation here. I mean, specifically, we're very proud of the engineering culture we have. We build everything that isn't available away. I do think it's a bit of a deeply kept secret that some of the best tech talent in the world is actually at the large financial institutions. We do have some of the world's biggest and most diverse data sets and some of the most complicated tech problems to solve. And so we are able to attract some of the best and the brightest. But there's no question that fintechs that can move faster, like Stuart's organization, can deliver innovation and ideas to us that we would not we would not develop internally. So I think the critical factor, though, is how do we partner with those fintechs in a way that we can really engage with them, given their innovation, but the requirements of our scale. That's really the trick.
Interesting. Yeah, I wanted to bring Melissa in on this conversation. How are you guys looking at engagement models and working with fintechs in innovation?
Sure. Thanks, Liz. There are some similarities to what Robert just talked about. I think we look at it as a two-pronged strategy. One, we invest in a fair amount of fintechs at various stages, not the earliest stage, but as they start to grow, both to invest in the leadership and the technology and solutioning that's being built, and also to find ways that we can, as Robert mentioned, scale it to our client base, whether we actually fully integrate, if you will, with our technology solutions. So investing and partnering and being part of the community, if you will, is a big piece for us. The second is we really have employed a buy, partner, build strategy. And we've bent more and more toward fintechs in that buy and partnership, where we find ourselves in, the state of where they can provide, as Robert said, better innovation, faster ways to solve a very specific problem. And, as Stuart mentioned, the ability to start from a different base, therefore already being cloud-based, already being in a more modernized stack, and then really determine how we can bring them and plug them in. I think the challenges that we face in those engagement models is sometimes, as Robert mentioned, the scale isn't there, or the levels of scrutiny from us, whether it's a resiliency, a security, or regulatory, right, are just new hurdles. They're not insurmountable, but they're new hurdles as you work together with companies like Stuart's or companies like Jay mentioned earlier, whether it's Blend or even as Encino was getting off the ground. So ours is, yes, invest, and in parallel, buy and partner, and really only build, as Robert said, when absolutely necessary, or when it's core to actually the criticality and core of who we are. And sometimes people move from we're investing and we're buying a service from them. Sometimes we're in partnership with them and then we acquire them, as we did recently with a platform from a company, Provide, that's here in the United States. So that's the strategy: buy, partner, build, grow with them, as Robert said, but invest where and as we can to help them get to the place where we want to be in business with them and others want to be in business with them too.
No, I agree. I've seen that so often where there's, a fintech company that a bank really wants to work with, but sometimes that scale issue comes in a lot. And when banks sort of take the time to work, to work with that company, so they get to a point where they can have that relationship that always leads to better success. No, it's really interesting. I'm going to move on, and I have to apologize to the audience. We're going to bring up the pandemic again, COVID, and probably the phrase that we hear most often talking about the global pandemic outside of you're on mute, is that it has accelerated digital adoption, digital transformation in many areas of our life, and the financial services industry is no exception. But I'm always curious to know, when I hear that COVID and the pandemic have accelerated these changes, exactly what has been accelerated. How has this worked inside your organization? What projects were sped up? And I was looking for some details and some stories. So Rob, I'm actually going to go back to you, put you on the spot again, to see if you can answer that question first. Like what did it specifically accelerate at Morgan Stanley?
Fundamentally at its core, I think, I don't know who I stole the phrase from, but necessity is the mother of adoption is really what we figured out in a hurry here. And I think organization, we had the great privilege of taking Zoom public quite a while ago, and therefore have a strong original relationship with them. They've been in our lab, and they were here way before the pandemic. We were ready, and our tech team was using Zoom for quite some time, but we really couldn't get anybody else to use it in the building until the pandemic. And then boom, the entire firm is at home on Zoom. You asked Jay the question. We will never go back. I mean, it's not that we won't come back into the office, but we will never go back to telephone calls only. And so I think, that reality, when so much of our firm and our own people started utilizing digital tools that they had never used before, it drove a level of understanding around the power and leverage we get out of digital transformation for our business and our customers as well. And I think that was a lesson that was a silver lining about the pandemic, and we will never unlearn. We saw our call centers, in fact, do even better when we had our call center employees having to work from home than when they, and I mean that from a service scoring perspective, right? So many of our wealth management clients started using our digital capabilities for the first time. And again, they will never go back. So I think it comes down to that everybody was forced to behave differently. There was all of this capability out there, more or less available or very quickly put online. And even if you think about our institutional business, the sales and trading markets businesses, you may remember the pandemic kicked off in early 2020. And volumes and volatility hit all-time records multiple times, day after day after day, in March and April. And that was across both the institutional and the wealth plans. The fact that we were already on cloud, which was somewhat of an esoteric concept to so many of our business leaders, meant that we could scale up and scale down very, very rapidly. And so for our business owners who run trading businesses, boom, they saw the benefits of cloud front and center because we were totally stable through those record periods. So I think it was just the tech was more or less there. People were finally forced to use it. It did everything it was promised, and I think we'll never unlearn it.
Interesting, yeah, and I'm really eager to hear everyone's views on exactly what was accelerated. So, Stuart, I'm going to go to you to find out what happened at your organization.
Yeah. Mainly for us, all those things were still true. So nothing really to build upon from an internal perspective. We are branchless, mobile first internet bank, basically, right? And so we just saw exceptional growth, as you'd expect. Saying CAGR year, and really what that did for us was give us confidence to go and raise money. There was a lot of money being sloshed around, as we know, from an institutional point of view, and that was then reinforced us to then hire more people and grow our product feature set. I think that's really important to what happened to Current as a company. In terms of like adoption of technology, we primarily bank people who don't often feel either welcome or feel that they have access to financial systems. And so predominantly people who are, working paycheck to paycheck or needed pandemic assistance. And of course, we all did our best, and the federal government as well. Like, we can all point fingers in hindsight, but at the time, I think what was done was fairly remarkable from a country perspective. In terms of the vaccine and also getting money, fiscal dominance. This was a new thing that just happened from a monetary policy point of view. And so getting to people who really needed it. Now, a lot of people who didn't need that money got it as well. And including some crime rings, I'm sure we've seen the headlines. And so I'm sure security and all this other stuff was accelerated for a lot of companies. But in terms of our core demographic, getting those checks, and some of them were physical when there were no branches, and we had to do all this, remote deposit capture stuff with things that really weren't from this mechanism, which was using the IRS data. That bit of tech, we were all hands on deck for about 2 weeks, making sure that we were the first fintech to get that money in people's hands who needed it the most. And so I'm extremely proud of everyone at Current and what we've done here for that. Of course, hopefully we don't do that again. It means the country's really not in a good spot. But yeah. And hopefully it's a one-off thing that we're going, okay, we don't need to do that. Well, maybe with this new variant, who knows? It sounds like Powell is gearing up again. But we'll see. So for us, that was the main, I would say, acceleration that we did not foresee come through, was the mechanism of money from the federal government into people's hands who needed it the most.
Interesting. Yeah, no, I'm going to go to Melissa. I saw you nodding your head to a lot that was saying, so I'd love to hear what happened inside your organization.
Sure. I think much like Rob and Stuart, there were some similarities there. I'd say starting as Rob did in terms of the internal focus, I moved from a global bank to a bank that's in the middle of the United States and works across the country, but is centered in the middle. Audio conferencing was a big deal. Video conferencing was not. And we certainly quickly found our way to a different reality and the ability to work where some are in the office and some are remotely. And I think that when you go through that rapid need to do it, it also opens people's eyes and minds and hearts, frankly, to the ability to work differently and do differently, which also unlocks innovative ideas for how you could do differently with clients. And so, as much as there's been so much hardship and so much loss as we've gone through this global health pandemic, that those things of people realizing, oh, I could do this differently, or, oh, there's a different way to operate, or, oh, it does work to operate like this, I think has been huge for us with just unlocking the power of people's ideas and people's innovation. I think on the client side, I'd say we much like we saw with our own employees, we also saw some opportunity areas, things where you had maybe certain corporations that we bank that were saying, this stuff I'll do digitally with you, but these things I have to sit down in person with my relationship manager. We have to go over this before I sign it. People in about half a second were like, "Can you send me the link? Can I e-sign that? Can you send the documents electronically? We can review it. I can mark up the PDF." All of that changed. So that necessity that people saw in our personal lives when it came to groceries or telehealth visits or things like that some might have never thought they'd do, we saw it similarly with not just our employees' willingness to adopt, but our clients' interest in adopting quickly because frankly, they had a need. And so I think that was huge for us. The Paycheck Protection Program, as well as the consumer, program for individuals that Stuart mentioned, were huge. And we certainly found ourselves needing to rally quickly, as Stuart mentioned, to provide, digital intake for PPP in the United States to help businesses stay in business and get their loan applications through our Small Business Administration was a massive need. The stories that people can tell with any bank of any size that they had to go through were difficult at first, as we were literally getting the rules and regulations from our government as we were taking applications, and then they were changing as we were taking applications. So being able to quickly change your digital intake form or what you were doing became very important to us. And then getting in touch with people so that they weren't waiting on the phone to find out did that deposit clear? Do I have the money from the government so I can buy groceries for my family while I'm out of work this week, as Stuart mentioned? Those were huge. But I'd say if you back up in the aggregate, for us as a company, and this happens when you're very large, we really got extreme focus and much faster paced decision making. And when you say, well, what can stay? As I said, as my teams launched a lot in a short time because digital and tech were critical, we can't work like that 100% of the time. When you have employees on your team who don't know what day of the week it is because they're working in their basement or their office attic or the extra bedroom or at the kitchen table while someone else is working, and they've lost track of the day of the week, that's not a pace that's long-term sustainable. It's not healthy mentally. It's not physically good. But having a faster pace to decisions, those of us on here for what we do for a living, it's not usually the tech parts that's the hardest. It's getting everybody aligned on what we're doing, nailing it down, and then getting to execution. And we learned a lot about our ability to do that with fewer cooks in the kitchen and still getting a great gourmet meal out of it. And I think that's a big win for us.
Excellent. Jay, I want to bring you back into the conversation because I really want to hear about more detail of your thoughts about what was accelerated at your organization.
Yeah, I'll switch to the human capital front, right? I think the other panelists have touched upon a lot of the interesting topics, but I think what we saw was a huge acceleration in the need for skilled talent, be it in the areas of financial crime and compliance, or in the areas of supporting commercial lending to support the PPP program, or just supporting our fintech clients with their growth. Just like Stuart said, many of our fintech clients grew 300, 500, 600% in the last 24 months. So just to keep pace with them, as well as all of our clients, we had to hire and train, because you can't go out and hire 1,000 people who are experts in anti-money laundering. The talent pool doesn't exist anywhere in the world. Right. So first of all, we created we really sort of leveraged our global presence, and we were able to, hire and train people bring them up to a level of competence that was necessary to do the job in a very, very rapid amount of time. And that broke a lot of the preconceived notions that somebody couldn't do this job with 3 or 4 weeks of training. We had to make it happen. There was really no choice. So some of that was exceptional, and I think we've learned on how to help clients set up new functions, execute new functions remotely without traveling, without being there physically, and that's been a pretty remarkable change as well.
Yeah, I'm very glad that you brought up the talent issue, because I wanted to move on to have a bit of a conversation about that. I mean, you talked about the sort of rapid training of new staff. I mean, was there a noticeable talent drain that you saw happen during the pandemic?
We saw a huge talent drain and a lot of pressure that our clients were feeling, right, in their local offices. Not necessarily in our offices, but our job became harder because we had to scale up quickly to support their needs. Right? The needs were growing. Thankfully, the economy recovered pretty quickly, and businesses were back to growing very, very quickly, right? And because of that, they needed manpower to execute. So we had to kind of backfill some of the losses that occurred onshore. And the so-called mass resignation, we had to support that with our staff, right, to a large extent. And the nature of our business as a service provider changed because it was no longer about augmenting capacity. It was about setting up new functions from scratch. It was about firefighting to keep the lights on with our client operations because they were losing people fast. So it's a very
Yeah,
interesting
so
time indeed.
yeah, it is an interesting time. So I wanted to ask Melissa, what type of, was there a talent drain that you guys saw? How did you guys handle it?
Yeah, I think we've seen an acceleration of talent moving across companies. And one of the things with more and more remote eligible roles, I guess I'll call it, in the US and frankly globally, we've seen as a company that's headquartered in the Midwest but has employees in many places, we're again in the center of the United States, we've seen the players on the East Coast and the West Coast, so think San Francisco and California, New York City and surrounding areas, hire more of our people and say, you don't have to move. You don't have to come to the higher cost market, right? To the more expensive place. You can stay, in Britain, you can stay out in the countryside. You don't have to come to London proper, which is maybe the pace of life you want, or maybe the size property you want, or maybe, not the expense of the flat. And we've really seen a bit of that, which has caused some churn within our own markets where we hire talent because we're competing over a smaller pool, I would say, as those open up to us. On the flip, we've seen people come who have said, I want to be part of something. The pandemic made me sit back and realize I want to be part of something with purpose, right? You heard Rob say earlier, like it's a little known or best kept secret that many of us have some of the best tech talent and data talent. A lot of us hire people that come straight out of, government security careers and things of that nature. Like you did see more people who either stepped back and said, I want out, not because I'm going to the East Coast or a global company or a Google or an Amazon. I just want to do something different with my life. I'm going to, give back with a different purpose. But we've seen people come for the same reason, to say, oh, I didn't realize until I read all about the fintechs and the banks distributing the money to people from the government, or the Paycheck Protection Program, which banks had to enable and then allowed people to keep their jobs when their small business wasn't open. You saw people say, oh, I want to be part of that purpose. How do I be part of that? So we've had more out than inflow, but it's helped us to recenter on what is the talent you need and what is the story you're telling to sell the people on the purpose of the job. It's not just about the code we're banging out for this simple solution. It's the larger thing you're enabling. And that's been a positive for us.
Interesting. Yeah, Rob, I saw you nodding along to a lot of what was said. What have you guys experienced at Morgan Stanley?
Well, I think Melissa's made some really terrific points here, and I think maybe part of what you're hearing from us is, these are very different, but three, I think, great companies. I'm not a big buyer of the Great Resignation as a concept, because the Great Resignation would imply they're all going to the beach. I think people are changing jobs, so if they're resigning, somebody else is hiring them. So I don't buy that whole concept as a general statement. Morgan Stanley, we are in a position, we acquired E-Trade not long ago. We acquired Eaton Vance shortly after that. So we are a company that is not a fintech by any means, but is certainly on a big growth trajectory in that regard. We will have had our record hiring year this year after a record hiring year last year. And I'm really specifically talking about tech talent. Now, that is not to say that attrition is not up. It is not to say that there aren't some terrific people often doing cool things like they do in Stuart's world, or going to the Googles and the Amazons. I mean, that's where we're losing people today on the tech side. We're not losing them to our historically traditional competitors. But net, I think if you have a value proposition like Melissa described, if you have some flexibility on offer, which is what we do today that we didn't before, there's a lot of really, really cool stuff to do at these companies. So I would say, companies like the three on this screen are probably net winners. And I guess maybe what I would more appropriately call the Great Rotation, Great Resignation.
Interesting. So we've got less than 10 minutes left. I do have a final question for all of you, but we have one audience question. If anyone wants to jump in on that, I'll just read it out. With the arrival of new tools to facilitate the shift from core banking systems to a more digitized format, what are the key risks that need to be monitored? Are fintech firms assisting in this area or not? What are the risks to watch out for? Who wants to jump in and see if they can answer that multi-level question right there? Melissa. I always go with the people that react. But why don't you try and tackle that one?
Let me start, and then I'll actually pass to Stuart, because I know actually they do a lot, and so do some of the other fintechs on how do we get better ready in the risk. I'd say this, Rob hit it earlier. It's about early partnership. It's about early investment. It's about scaling and growing together. And it happens to be, for those that aren't aware, that Stuart's company is one that both of ours have worked with. Ours in an investment front, and Rob's in the way that they talked about earlier. But for us, it's really about how do you help people kick the tires. I think in the old days, right, you'd have people say, oh, they don't understand, or they don't know how to get it, or that tool won't work, or you don't really understand the regulations that we deal with. Now it's more about how do you bring the people together so you can explain, hey, this is the challenge, and then really smart, innovative, faster cycle folks can figure out how to come up to that challenge. And I think some of the most innovative things that I've seen, even globally, before I came to Fifth Third, are actually work that fintechs have done on the know your customer front, on the anti-money laundering front, on different ways to look at different data sources and how we can actually go after that. And then you take companies like Jay that go after the business process. But I'd say how we do it is we kick the tires not as hard. We kick them harder than we've ever kicked them before, because people who are going to commit fraud and do bad things from a security standpoint are getting smarter and smarter. They have entire institutions that are funded really, really well, and then operate with entire call centers of people who are calling and trying to defraud people. So we have to be bigger, better, tougher with our standards than we ever have. And so do companies like Stuart's. It's not just the burden of a large bank. It's the burden of all of us. And so then we need folks that are in faster cycle time, smaller package releases to really quickly come up with solutions to some of the risks. And I don't know, to me, I think we look at it as thought partnership, thought leadership, and no individual ownership of whoever has the best idea. And I'd pass to Stuart on that, because I know he's one that personally with his firm has led in those areas.
What do you think,
Stuart?
I
mean, that's awesome. I mean, Melissa's nailed it. I think from the only thing I could really add is, yes, you can point out risks of, around the tools of having new ledger and going cloud-based, which could be stability, or, AWS East goes down, which we've seen, right? We've seen we've seen GCP go down, most recently for 5-10 minutes. And, you can look at the negatives, and you could also look at, some of the older compliance and regulatory language that you could, if you wanted to, bend it to say no, right? You're like, all right, no, because that's the default position. I think the real risk here is that you don't do anything. Whoever asked that question is the risk really is that you don't have any innovation. right? And I think that now, after what we saw in 2020, outweighs the risk of like having some things that you need to fix. That's where I'd put it.
Interesting. So we've got about 5 minutes left for our discussion, and I want to have a final question for each of you, and I want all of you to be able to get your say. So this is our looking ahead question on what should be the key priorities for digital investment in the industry. So Stuart, I'm going to stick with you to be the first one briefly. What do you think should be the key priorities going ahead?
I mean, this is a very person who's listening specific, right? So for us, I mean, the thing that would be common to all is engineering, technical talent, product management. If you can get it, I think, you've heard from everyone, and we're the same. Like we don't grow in the want to grow mainly due to not adding enough technical talent quick enough. We don't have net attrition, but we do on the other side. We're like, come on, surely we should be hiring more. Facebook hired a zillion, we should be hiring this many. So I think that would be the focus. I think before you get there, you have to understand your culture, and that's a sort of catch-all word for saying you need to align incentives. Investment banks were very good at that, at aligning incentives with their employees. I think fintechs and tech firms are very good at that. I don't know if incumbent banks are good at that, right? And so aligning incentives, making sure that the culture and the success and the hard work that really are people, because you're rebuilding stuff that has not really been rebuilt for 50, 60 years. And so you're asking a lot, and so that they have to participate as an owner in the upside of their work. And I think that bit is really important. And so that then you're able to lay the groundwork to attract good talent, plus all the other interesting problems that you want to solve. And look, if I was on the other side, I would just fast follow fintech. I wouldn't even think too hard. We do a lot of hard work on this side, and it kind of works. So if I was in an incumbent bank, I'd be just like, I'm just going to do whatever they did, and maybe it's a year late, but at least I got distribution. That'd be me.
Wonderful. So I want to make sure everyone gets a comment, at least a minute each. So Melissa, what are your key priorities, do you think?
Well, stealing from Jay, hyper automation and really just automating as much as we can, right? That's better from an efficiency standpoint. It's better from a no mistakes for your clients standpoint. And it allows you to actually upskill and reskill your talent to deploy them to more and better things, which then relates to Stuart's point about culture, continuing to recruit the talent you need, but really make sure you're retaining them and you're exciting them about where they're going. And we're all in the business of engineering talent and people that are very skilled in cyber and skilled in cloud and skilled in all the modern technologies. And so that's a huge focus and a huge priority to almost, as Stuart said, try to hire even more than you think you need, because there's plenty of great work to be done. And then I'd say the other one for us is just continue to stay hyper in tune to what the clients are talking about, what the clients need, and what the clients want, and make sure that we're really, really focused on that. It's easy, as I'm sure some people could admit. Like at first, everybody washed their hands 30 plus seconds. I'm sure if I surveyed people, we all don't do as good a job of that this far into the pandemic, but we might be using our hand sanitizer, right? So how do you make sure you don't pull back to gravity into old habits? Stay extremely focused on what the clients and the employees have told you worked best for them and bringing those solutions out the door. And as Stuart mentioned, he said fast follow. I'm just all about how do we buy in? How do we partner? How do we find more and better so that we can plug things together in a seamless way for clients? That's our focus in terms of our finances and our investment.
Lovely. So Jay, do you have any brief key priorities you can share briefly?
Yeah, I think just connecting the dots to, Stuart's previous point on the risk of not doing anything. I think everybody agrees without any sort of doubt that, a digital agenda, transforming your operations is front and center, right? That's on everybody's agenda. The issue that we see, having looked at a diverse set of clients, is that there's a group of clients, banks, sometimes incumbent banks, who don't necessarily align the right senior sponsor behind those initiatives. And that's the death nail for those initiatives, right? And you need people like Melissa and Rob, driving these initiatives. And if you don't have that, at the senior-most levels in the companies, nothing happens. And that is what we've seen too many times with some of the incumbent banks. And until that changes, those, some of those companies will struggle to stay, catch up with what's going on.
Wonderful. Hoping we can get Robin to get some of your key priorities so that you can bring us
It's
home.
really straightforward and super simple. I mean, digital transformation is new, but at the end of the day, it all will come down to your clients and your talent, and those two come down to your values. And I think that if you keep, as an organization, your eyes on the prize, what really matters for your clients, what really makes a difference in their lives, you're going to attract the best talent, the most diverse talent. You're going to retain that talent. And if you have the best talent, you're going to win. And that's what I think we're trying to do here at Morgan Stanley. It's not tech for tech's sake. It's not transformation just because. What is it that we can do to make our clients' lives better? And we have a whole bunch of people who buy into that mission, as Melissa described it. We try to live our values as a firm, and that seems to work for us.
Wonderful. I want to thank the panel. And for the audience, all sessions will be available on demand for 90 days on the website. So please stay tuned. We're going for our closing keynote interview with Al Kelly, CEO of Visa, who's interviewed by Amani Moise, FT's U.S. banking correspondent. Thank you, everyone.
Thank you.
Thanks,
Thank
everybody.
you.
Bye-bye.
Bye.
Sorry it went over.